Good afternoon, and welcome to today's state and local tax webinar, Strategies for Technology Companies in 2025 and beyond. I'm Tom Porcelli, partner and co-leader of the Technology and Digital Media practice here at Citrin Cooperman. I'll be your moderator for today's webinar. We're thrilled to have you join us for what promises to be an insightful and engaging discussion on the ever-evolving landscape of tax planning for tech companies. Participation is encouraged, so feel free to submit your questions in the Q&A section of the webinar. And please indicate if your question is directed at a specific speaker. We have an impressive lineup of presenters for you today. Jamie Reichert, partner and national, state, and local tax practice leader. Tom Walsh, partner in our state and local tax practice. And Bob Alpern, partner and national federal credits and incentives practice leader. They will be covering a variety of topics, such as software and SaaS taxation, simplifying complex sourcing, tax treatment for digital advertising services, strategies for maximizing R&D tax credits, Section 174 cost strategies, specialty credits, and energy incentive tax credits, Section 48. Before we get started, for those of you who are not familiar with Citrin Cooperman and our technology practice, we are one of the leading national accounting and advisory firms in the country, providing a broad range of services, including audit, tax, and consulting. Founded in 1979, the firm serves clients across various industries. Known for our personalized approach, we focus on delivering strategic insights to help businesses and individuals navigate their complex financial challenges. Building on our broad range of services and commitment to personal solutions, we have a particular focus in the technology and digital media space, where we work with dynamic, growth-oriented clients. Specifically, we serve SaaS developers, software developers, digital media companies, data analytic firms, fintechs, ad techs, and many more. These companies, often VC-backed, who are preparing to raise capital, span from pre-seed, pre-revenue startups to larger organizations generating up to $500 million in revenue. Due to their rapid growth and evolving needs, they face unique challenges in areas such as financial reporting, complex equity transactions, valuation matters, international tax matters, and like our discussion today, state and local tax matters. We look forward to an engaging session and appreciate your participation. And without further ado, I will kick it over to Jamie Reichert and our presenters.
Thanks, Tom, and hope everyone is doing well. Thanks for joining us. We have a bunch of material and topics we're going to touch upon today, and we've kind of divided it up based on broad range of taxes, right? So first, we're going to touch upon some topics related to state income and franchise tax issues, specifically a little bit of background of how they work, how the tax computations work, and how technology software companies, SaaS, as well as data services companies can take advantage of the different rules to reduce their taxable income. And then we're going to talk about specific examples from a case in Massachusetts, as well as an opportunity in New York City. And then we're going to talk about tax subjectivity rules and how to avoid potentially being subject, state elective pass-through entity tax, and what that means and how to take advantage of it. And finally, we're going to get into what happens when you're ready to sell your company and different things to keep in mind and the sort of rubric of rules that apply and how to strategically take advantage / maneuver around them to potentially avoid state income tax or franchise tax on these transactions, including equity compensation as well. So for those maybe that not necessarily business owners, but maybe have equity in the companies through employment, we're going to talk about some issues that relate to that as well. So next slide, please. So just a little bit of background from a state income and franchise tax perspective, right? Similar to federal corporations, right? Corporations that are taxed as C corporations for federal are generally taxed as C corporations for state income tax purposes, right? And they're taxed at the entity level. And there's corporate income tax in roughly 44 states in the United States. Some states, however, impose in tandem or instead of a corporate income tax, various what we call franchise or gross receipts taxes, with these taxes imposed on gross receipts or imposed on some measure that includes gross receipts, but maybe certain limited deductions. And states that do that include Delaware has a gross receipts tax, Nevada has its commerce tax, Ohio has the commercial activity tax, as well as Oregon has one as well. In addition to a corporate tax, so Oregon's one of those that has both. Texas has its franchise tax, and Tennessee has a business tax as well as a franchise tax, in addition to an income tax. And Washington state has a tax that's imposed on gross receipts. And similar at the state level to federal, right, when we're dealing with pass-through entities, right, partnerships, S corporations, right, where the owners bear the responsibility for the tax and report the income, right? We've got 43 states around the country that impose broad-based personal income taxes. So again, in that context, right, the owners are the ones that are generally going to be paying the tax, with certain exception that we're going to talk about in a little bit later. So how do these personal income taxes work, right? Because a lot of tech companies may not be structured as C Corps, so maybe there's pass-through entities. So how are the ultimate owners taxed? So from a state perspective, a resident, right, when you're a resident of a particular state, you're going to pay tax on all income, regardless of where that income is earned. Whether as a non-resident, right, where maybe, so we're filing a return because we earn income from a particular state, right, you only report as a non-resident the income that's earned in that state, right, because you don't pay tax on all income to a non-resident state, you only do that in your state of residence. And to avoid the double tax problem, right, because as you can see, if you pay tax to your home state and you're paying tax to another state where income is earned, right, there could potentially be double tax on the same income. And so to guide against that and to guard against that, the resident state usually provides what's called the credit for tax paid, right? So you'll get a credit for taxes paid to other states. And in the C corporation context, or for non-residents that owners of pass-through entities, S corps and partnerships, those companies get to apportion their income. And we're going to talk about in the next slide exactly what apportioning income means. Next slide, please. So apportionment, right? That is basically how you compute how much of a company's net income is going to be reportable and subject to tax in the state in question. So think of, the company's net income as a pie. Apportionment is the formula that's utilized for how you divide up that pie amongst the reporting states. Some states use formulas that, as you can see on the screen here, use property, payroll, and sales. So you'll actually compute a percentage for in-state property over property everywhere, and you'll do the same thing for payroll as well as sales, and maybe you'll add those together and take an average. But I will say that most apportionment formulas around the country have been shifting to what we call single receipts factor apportionment, meaning they only look at the sales factor, the receipts factor. So the net income is essentially multiplied by the following ratio of in-state sales, right, divided by everywhere sales. So obviously, based on the importance of the sales factor, the next key question is, so how do we determine sales, right, in-state revenue? So next slide, please. So we do it based on the following set of what we call sales factor sourcing rules. So when we sell tangible property, right, if we're selling physical products, those are generally sourced based on the destination of the product, right? So that's how we're going to compute those sales in terms of apportionment. When it comes to services, right, when we're providing service and not a physical product, typically there's two sets of rules that apply. One set of rules typically look to where services are performed, and they look to where the costs of performance are incurred in measuring how to basically allocate where those services are performed. So typically the cost is payroll, right? So a typical service provider will allocate to states with this cost of performance rules based on the payroll percentage that they have in the state as compared to total payroll. The other set of rules that comes into play is what we call market sourcing. Market sourcing basically says you look to source that revenue based on either where the service is delivered or where the benefit of that service is received. And in more detail, we can see in the next slide. So next slide, please. We get into specifically the different set of rules that apply when, again, it comes to market-based sourcing. And as you can see on the slide, right, it gets to customer location, right, where's the benefit received, or maybe where's the service delivered. And then when we deal with intangibles, right, maybe we're dealing with, income from various patents, trademark, revenue, licensing revenue from different intangibles, we will typically look to, in a market sourcing state, where that intangible is used, right? Where is the customer utilizing, the intangible that they're paying for? Versus when we're dealing with a cost of performance type state, you'll typically look to where's the domicile of the company that owns the intangible, or where is the payroll and property that was incurred in developing that IP, in which state was that, right? So as you can see, there's sort of this different mishmash of rules when it comes to sourcing of revenue. And next slide, please. So why do I bring that up? And with all that background, right? Again, with the key point being how we calculate taxable income, whether it's a C corporation or for non-residents in states where our pass-through entities are doing business, right? What is the importance of this discussion of revenue sourcing? So as you can see, right, depending on the type of product we're talking about, you could categorize it in several different ways. And there's different ways to source those products, right? So electronically delivered software, that could potentially be viewed as tangible personal property when we use most state sales tax rules, and a lot of income tax rules have adopted the sales tax definitions. And so they would say, where's the destination of that electronically delivered software? Where was it downloaded to? Where was it downloaded from? Versus maybe it's categorized in some states as an intangible. So in this case, then we would think about, okay, where was it utilized in certain states, or in other states that look to where the costs were incurred in developing that intangible. Where is the ultimate, where's the owner of that IP, right, or the software? Where are they based? SaaS, similar type analysis, right? It could be tangible personal property. Maybe it's a service, right? Software as a service. In which case, then, right, we look to could be cost of performance, where the costs are incurred. Could be where the customer is, where the SaaS is utilized. There's all these different rules, and same thing for data hosting, as well as in information retrieval services and database services. You could categorize, right? The point of this exercise is you could categorize these services very differently depending on each state. And the cool thing is that all states use different rules. So you could take advantage, right, in a way that's strategic, but following the law and the tax code and not doing anything risky by essentially saying, well, maybe one state, right, is going to look at the destination, while another state is going to look to where my company's operations are. And therefore, potentially, there could be nowhere revenue, right? Maybe that revenue utilizing those states' rules isn't getting sourced anywhere, depending on the particular fact pattern. So the key point here, again, is that there's different rules for calculating the taxable income based on these sourcing rules. And all the state rules are different, and you could take advantage of those differences. And it's not a zero-sum game. So just because we're taking 60% of our income out of New York doesn't mean that 60% now has to be reportable somewhere else. Because there's different rules, like I said, they don't all interact with each other. And that's where we can potentially take advantage and lower our tax, again, whether it's a C Corp or when we're dealing with non-resident states for a pass-through entity. Next slide, please. So real-world examples of how this has actually applied and has taken place. Massachusetts had a case that came down in 2022. There was the Akamai Technologies case, and it involved a SaaS developer, right, software as a service. And the end result of the case was that the court determined, and now there's guidance that Massachusetts has issued an information release supporting this, that SaaS developers and SaaS, right, is treated as tangible personal property from an income tax perspective. And in Massachusetts, that has a lot of implications. During those tax years, that meant that you could use an apportionment factor just looking at sales instead of including property and payroll, right? And then sales used a destination approach, a customer-oriented approach. So this basically favored an in-state based, company that had a lot of their operations there. Additionally, there's sales tax exemptions and property tax exemptions available to manufacturers of tangible personal property. So under this case, right, in Massachusetts, the taxpayer was able to get tax savings from changing the taxable income calculation that we just went over, and got a host of different exemptions as well by virtue, again, of being categorized as a manufacturer of tangible personal property because it developed a SaaS product. Similarly, in New York City, we have two taxes that apply in the non-corporate C corporation context. We've got the New York City UBT, the Unincorporated Business Tax, and then we have the New York City General Corporation Tax that applies for S corporations. So the UBT is generally for partnerships. The GCT that I just mentioned is generally for S corporations. And in those codes, they actually have language talking about how if the SaaS / electronically delivered software is treated as software and TPP for sales tax purposes, it's treated like that for New York City purposes as well, meaning a heavily based New York City SaaS developer, right, or a company that has developed electronically delivered software with all operations in New York City that maybe historically under the rules was apportioning and sourcing all income to New York City, and the tax rates are fairly significant, they could have been paying a fairly hefty amount of New York City tax. This position allows you to source your income based upon where the customers are. And so if not all the customers or a lot of the customers are outside of New York City, this can result in a real tax savings for these companies, again, software and SaaS developers that are operating out of New York City. Next slide, please. So another opportunity is Public Law 86272. I won't go over the history, but in a nutshell, it's really just a federal law that says if you sell tangible personal property into a state, your company, and you only sell tangible personal property into the state with some limited marketing activities, you are protected from being subject to a net income tax. And so the benefit of this, right, is now software, SaaS, and certain data products are being categorized as tangible personal property under the income tax laws. Now, all these companies that maybe historically have thought we are not protected from income tax under this public law can take advantage of it and be protected from being subject to income tax in all of these states, where again, they're just selling their SaaS or software product into. So that could be a significant savings, and not just on compliance, but on the actual tax costs. And importantly, this applies for owners of pass-through entities as well. So an owner of a pass-through entity is under this protection if the company is protected as well. But importantly, this protection does not extend to, remember, we talked about those franchise gross receipts taxes in Texas, Ohio, Nevada, etc. This public law does not protect a company against being subject to those taxes. Next slide, please. So I mentioned that most state, right, in the state context, like federal, pass-through entity owners are generally taxed at the owner level, right? The entity does not pay tax. But something new that's come about in the last couple of years since the Tax Cuts and Jobs Act passed in late 2017 was state elective pass-through entity taxation. And in a nutshell, what this really is it's a tax saving strategy for people that maybe are paying a decent amount of state tax, whether it's property taxes and income taxes all together, that are subject to the federal SALT cap, right? The federal SALT cap back in 2018 put in place essentially a cap on the individual's deduction, right? I, as an individual, can only take a maximum itemized deduction of $10,000 for all of my state and local taxes paid. And obviously, if you're a business owner, right, and you're operating in several states and maybe some high tax states, this $10,000 limitation is prohibitive and can be a major, cost and tax hit to the owner. So as a result, many states, really quite frankly, most states that have an income tax, 36 of them, have passed these elective pass-through entity taxes. What that means in a nutshell is the pass-through entity makes an election to pay tax at the entity level. And therefore, what the benefit is, because the tax is paid at the entity level, it's not capped as an individual deduction because the individual is not paying the tax. The entity is. So for federal purposes, when the entity files, whether it's a 1065 partnership return or an 1120S, right, S corporation return, it gets a full deduction for the state taxes, and that flows through to the owners versus not taking advantage of this elective pass-through entity tax, paying all the taxes as an owner, and getting capped at $10,000 for my total state tax deduction. So this is kind of a workaround around that cap. And like I said, 36 states have adopted it. And the IRS has blessed this concept in IRS Notice 2020-75, where they've indicated they approve of this. But there's individual rules and sort of deviations between the tax bases, how tiered structures work, if maybe you have a partnership that owns another partnership, or an S Corp on top of a partnership, or where you have owners in different states. There's different nuances to think about that are important for how these taxes work. But theoretically, right, the tax benefit would be for state taxes that you're not getting a federal deduction, take the state tax amount and using a 37% tax rate, for federal purposes, multiply that, and that could be the potential benefit of additional savings at the federal level by taking advantage of these elective state pass-through entity taxes. Next slide, please. And so importantly, just with these taxes, there's certain due dates that are super important that allow you to elect in. California has this requirement that you have to make a payment in June 15, or else you can't elect in for that year. Maryland says you got to make your first election. You got to make the election with the first estimated payment for the year, or whatever filing is made for that year. So whatever first filing you make, whether an extension request or an estimated payment or something, you've got to do it. You got to make the election on that paper form or electronically. New Jersey, the March 15 deadline for the previous year to elect in. New York has a deadline of March 15 for the current year. So these deadlines are just important because if you miss them, you actually cannot elect in and you lose that total federal tax savings. So it's very important. And if you have a transaction upcoming, that's why we often recommend keeping these dates in mind and maybe starting to set up entities for the transaction to allow the entity to be able to make these deadlines for elections to pay these elective state taxes. Next slide, please. So I mentioned transactions. When we think about transactions from a pass-through entity context, or even as a C corporation, typically sale of assets, right, an asset sale, that's generally always going to generate business income that's going to be apportioned in the states where the company does business. That's just the nature of how state taxes work, and really, there's almost no exception to that. But when it comes to sale of entity interest, right, selling stock, let's say, or selling partnership interests, that's where the rules can deviate. Where typically sales of stock, you don't typically pay tax to a non-resident state, right? And so that's why a lot of the time before company sales, right, before transactions, maybe owners will move to states like Florida or Texas where there's no income tax, or even maybe a state like my home state of Pennsylvania, which has a low tax rate of 3.07, and thinking about the tax savings, right, when they go and sell their pass-through entity interests. So typically, right, it's similar to stock, sale of partnership interests don't generate state source income when it comes to a non-resident, but there are states that do what we call look through, and they actually look through to the company's apportionment. That, remember, we talked about how a company apportions income to basically figure out how much of a percentage they get to tax of the sale of a partnership interest. So examples of states that do that are Arizona, Colorado. New York does it when there's a 100% interest transfer of the partnership and the purchaser treats it as an asset acquisition. Massachusetts does it, Maine does it, Minnesota, Ohio. So there's certain examples where, again, the sale of the partnership interest in these states will actually create state source income. So that's important to keep in mind, right? And why are these things even important and to keep in mind in consideration of the pass-through entity tax we just talked about? So asset sales, right? The entity, a pass-through entity sells its assets, that's going to generate income that's subject to pass-through entity tax. And there's likely going to be a tax benefit for making that election and paying, versus an individual selling a partnership interest or S Corp stock, right? That's not going to create taxable income at the pass-through entity level. So they're not going to be able to take advantage of those elective pass-through entity taxes. So that's something to keep in mind in structuring, and why sometimes we'll see holding entities, right, where maybe an individual held a partnership interest. Now there's an S Corp or partnership that holds that same partnership interest, so that a pass-through entity, the income is flowing through a pass-through entity, so that then there is the opportunity to elect in and pay these pass-through entity taxes. So that's some of the structuring to keep in mind, again, to be able to take advantage of these pass-through entity taxes on an asset sale or an entity interest sale when you're ready to sell the business and have a federal tax savings as a result. Next slide, please. And then the final piece that I'll just mention is equity compensation, right? So maybe there's stock options that have been received, maybe profits interests, maybe preferred stock, restricted stock, all different forms of equity comp. And typically, this form of compensation is going to be treated like any other wages or compensation earned by an employee, meaning that, first of all, like always, state of residence, you pay tax right, on all your income. So any income when it's recognized for federal purposes from these types of equity compensation is going to be recognized for state purposes in the same period. And residents are going to pay tax on all of it, wherever they live, versus non-residents, right? So how does a non-resident deal with this? So typically non-residents you look to the period of service, right? So, and you look to the grant date, right? When this equity comp was granted to either, from that period, excuse me, from that period to the exercise date or vesting date. And in that total period, you look to how much of the total days of services were services performed in the state in question we're talking about. So let's say we're talking about New York State. You worked for a New York State employer, and you would look to, again, the period of time from grant date to vesting exercise date, and looking at how much time was spent performing services in New York to determine the amount of income that's going to be subject to New York tax. And just things to keep in mind is that some states have convenience of employer rules, Connecticut, Delaware, Nebraska, New Jersey, New York, PA, where those rules say, right, because a lot of people are working remotely now, that if you're working remotely for your own convenience, that those states, and if the office is in one of those states, your income compensation is still sourced to those states and subject to tax. So the importance from an equity comp perspective is, let's say, right, from the grant date to vesting or exercise, we've been working remotely for our own convenience, and we think we don't have to allocate any of that income because we've been working outside those states would say push that income back, and it's going to be subject to tax in those states. So it's important when planning to keep that in mind, and maybe shifting to a remote status within the company, or if the company has several offices, shifting the office where the employee is technically assigned to a non-convenience of employer jurisdiction. So I'm going to jump ahead and turn it over to my colleague Tom Walsh now to get into some sales and use tax and indirect tax issues.
Thanks, Jamie. All right, so let's jump into sales tax. The sales tax, you can change. Yep, thank you. The sales tax has evolved over time, as you can imagine. Originally, sales tax was limited to the taxation of stuff when you purchase it, the retail sales of tangible personal property. And over time, they expanded that to include specifically enumerated services. And over time beyond that, as states began to need revenue, that list of enumerated services has increased more and more. There's some exceptions to that. Hawaii taxes just about everything, and New Mexico does too. South Dakota, West Virginia, they focus very much on services. But overall, the assumption is tangible personal property and specifically enumerated services. Software, as you can imagine, has evolved sort of the same way, the taxation of software. If you're old enough to remember, when you purchased software, you were given something tangible like a disk or a drive or something, and that's how you loaded your software on to whatever devices you needed. And that would be considered a purchase of something tangible subject to sales tax, most likely. As time has gone on, the delivery, as it's changed, has also found itself determined to be taxable in some jurisdictions. If you look at the list here, this is a cross section. There's probably about 12 states listed. I think it's the states in which we have offices. You can see the difference, but from state to state in the taxation of both software as a service and downloaded software. There are some complicating factors. So I think SaaS is taxable in about 25 states throughout the country, and then there's another number of jurisdictions, local jurisdictions, that have gone rogue and subject to tax where their state doesn't necessarily. There's even an outlier in the city of Chicago where they have the sale of SaaS is not subject to tax, in the state of Illinois, but Chicago has its own rental tax that they're applying broadly to now software as a service. There are other complicating factors. There are exemptions for business to business type purchases, business process type purchases. So, when it comes to software, it's going to be very specific from state to state. We'll move on. So, as you can imagine, and as I'm sure as you're aware, the charges that come along with software and its different iterations brings different taxability decisions along with them. For example, maintenance contracts. The taxability for maintenance contracts can come down to whether they're mandatory or optional. Upgrades and updates. That's treated most often as the same as the taxability for the purchase or rental of the tax itself. Analogous installation, repairs, and maintenance charges. Those could be treated as the same as what those charges would be if it was installation and repair of tangible personal property. New York has taken a broad interpretation of their security service, enumerated service taxability, where they've expanded that security service that started out as just, say, guards, to now including cybersecurity, your Kaspersky's, your spam filters. That's now subject to tax in New York State. And things keep changing. Pennsylvania just this fall changed some of their interpretations when it comes to services that are provided in relation to software being utilized as part of it. So if you're a consultant and you are utilizing software as part of your consultancy, then that might be subject to tax, whereas management consulting that does not utilize any kind of software would be exempt. So, the guidance coming out is forever moving, it's forever changing, and I suppose what it yields is a certain amount of job security for guys like Jamie and I. Customized software, generally not subject to tax. However, there's a thin line between customized software that's specifically developed for you or your company, and that of a canned software that's manipulated after the fact, and trying to squeeze that into the customized software exemption. Oftentimes it does not. So separately stated software modification charges, generally not taxable. Data processing shouldn't be subject to tax, right? But there are certain states, Connecticut, Texas have reduced rates, DC, Ohio. Those states do. And what one needs to look out for is those data processing services towing the line between something like a taxable information service or even a taxable SaaS. So it takes some speculation when making these purchases, so be aware. Platform as a service. So a whole different set of rules. It doesn't necessarily match up with your SaaS taxability matrix. So be aware that platform as a service could potentially be subject to tax. And the same with infrastructure as a service. Outsourced IT functionality, that type of thing. When software is involved, every state has their own opinions on how they're going to handle those. Next slide, please. In the least surprising development, New York has taken another aggressive stance. So through case law and guidance, New York has basically settled on the fact where if there's a service being provided and it utilizes certain functionality of software, whether that's remotely accessed or some other way, then they're going to subject to that to sales tax in New York. And this flies in the face of something like Massachusetts, who has taken the position, and it's a much more, say, rational way of thinking about it, where, well, they decide, is it really the service that you're purchasing, or is it the software? And if the software turns out to be a de minimis aspect of the service that's being provided, then the result would be non-taxable, as opposed to New York's take, which would be taxable. That brings me to the bullet point that we listed at the beginning of this section, which was due diligence. So the firm handles numerous state and local tax due diligence projects. We handle the federal side as well, but this is a SALT-focused statement here. So the area where most deals get tripped up is the area of sales tax, particularly for younger nascent businesses that put so much time into developing their tech solutions for their clients, and didn't necessarily have the wherewithal or the knowledge about how complicated the sales tax side of things can be when making sales. So the design of the deal doesn't necessarily mean that you should not pay attention to tax due diligence. Asset deals and stock deals, either way, the potential for inherited sales tax exposure exists for either design of your deals. Keep that in mind. So whether it is a buy side, if you're looking to purchase a company, or whether you're looking to get out in front of a sale of the company, highly recommend doing a federal and state due diligence as part of your prep leading into a deal. And with that, I'll kick it back to Jamie.
Okay, thank you, Tom. And again, I just want to underscore Tom's last point that all transactions that we work on, and from a diligence perspective in the tech world, this is the most common issue that causes a problem, and then we have to decide and write memos whether or not we think it's taxable, and quantify exposures, and hold proceeds back, or do all sorts of indemnity provisions. So that's why it's so important, as Tom mentioned, from a deal perspective. So really quickly, going to run through the last couple of items from a SALT perspective before we turn it over to Bob. One item is manufacturing and R&D exemptions. So most states have some form of a sales and use tax exemption for personal property, equipment, various items that are purchased and utilized in the manufacturing, excuse me, or process. And even some states like California, New Jersey, PA have an R&D exemption as well. So for the same type of equipment and property and items and supplies that are used in R&D processes, there are exemptions. And in thinking through, right, now that software SaaS, right, as we talked about in all that different modules earlier, is going to be treated as TPP and even different data services, right, then the items purchased in creating those products and supporting those products then arguably are going to be eligible for these different sales and use tax exemptions. So that's just something to keep in mind from a sales and use tax perspective, because most vendors take a fairly conservative view and just charge tax. So there may be opportunities to recover that tax. Next slide, please. So multiple points of use sourcing, what does that mean? So all of our businesses mostly, whether we provide services, whether we sell widgets, whether we lease things, all sorts of stuff that we do. We're using software in some way, or specifically we're utilizing SaaS, right? Software as a service. A lot of software today is remote access and can be used from anywhere and accessed anywhere. And so the key point here is, like similarly what we mentioned for exemptions, vendors are typically going to charge sales tax when they see the contract, right, or the billing address is in a jurisdiction which imposes tax, right? So if it's in, let's take New York, right? We have our firm, right? Citrin Cooperman, we have a big office in New York, and that's home base headquarters. And we buy software, and our location lists New York. The vendors are going to charge potentially New York sales tax and think that they're complying, and that's correct. But New York, as well as states like Illinois, Massachusetts, Pennsylvania, Washington, Utah, and others, allow for what's called multiple points of use sourcing, where let's say the case of, again, the office lists New York, but maybe employees are utilizing it all over. And maybe in some states which don't impose tax, where the tax rate is lower, you can potentially carve out the sales right from New York that are being utilized in other jurisdictions, the SaaS licenses, from New York tax. So you can apply for refunds, as well as letting vendors know where the individual licenses or users are so that they can charge the appropriate tax and reduce the tax as appropriate. So again, it's just another point of savings that can be pretty substantial because, as you know, these licenses can add up and be expensive. Next slide, please. Digital advertising, the key takeaway point here is that we're seeing a lot of states, New York being one of them, but it's happening in a lot of states, where digital advertising or products that are categorized as digital advertising are in some way utilizing either a SaaS component or are in some way using third-party data or like benchmarking data that's not specialized to the particular client. And that's another way where states are going after it and charging tax as information services. So we're seeing a lot of our clients, both as purchasers, being charged tax, and sometimes the tax is wrong and the service shouldn't be taxable, and we're recovering that sales tax. And some of our clients that are providing these services, guiding them right in all the maze of rules that Tom went over in terms of how to treat these items. Next slide, please. And then final point I'll just touch upon is state credits and incentives. Right, so for companies that are hiring, spending some money, right, and getting new locations, those are the typical touch points, right? So capital investment and employment. There's an array of different credits and incentives across jurisdictions that are available, from income tax credits, right? And those credits, even if you don't have tax, maybe can be sold, carry forward, or can be refundable. So there's different ways to monetize those incentives that we help with all the time. There's cash grants that are available from different states for new withholdings generated from employees. There's different property tax abatements and savings, angel investor tax credits. New Jersey has an NOL program that allows tech companies to sell their unused net operating losses as well as R&D credits. And then, as I mentioned, there are sales and use tax exemptions that you don't even have to apply for that are as of right. So the key point to take away from this is that there are different incentives available, again, in the employment investment standpoint, and reach out to your representative early on so that you can get ahead of the process before missing out and not applying for these potential benefits. And then in the last slide, next slide, please. Last slide is just a chart which lays out the different types of benefits from tax credits, grants, and different preferential financing that are available across some of the major jurisdictions that a lot of our clients are, and we do a lot of our work in. So that covers the SALT piece. And now I'm going to turn it over to my colleague, Bob, who's going to cover federal R&D credits as well as other incentives.
Thanks, Jamie. Hi, everybody. I'm Bob Alperin, and I'm a tax partner here at Citrin Cooperman and lead our federal credits and incentives practice. Today, I'm going to talk about Section 174, R&D cost capitalization, a couple of issues related to R&D credits, both the new Form 6765 requirements, as well as R&D credit refund claims. And then I'll touch on the payroll tax credit as well. And you may be asking, well, why is a federal credit and incentives guy talking on a state and local tax tech call? Well, R&D is of the utmost importance to most tech companies and the benefits associated with it. And a lot of the issues that credit and incentives issues at the federal level overlap with state issues as well. So let's go to the next slide, please. So we'll start with Section 174 capitalization. Quick background on 174. Section 174 deals with R&D expenses. Prior to 2022, taxpayers were able to expense R&D costs currently. From 2022 forward, taxpayers are now required to capitalize R&D costs. And if there are R&D costs that are performed in the US, they're capitalized and amortized over 60 months. If there are R&D costs that are performed outside the US, they're capitalized and amortized over 180 months. So, this hurts a lot of tech companies, especially startups. But it is currently the law, and there are a lot of questions out there about whether or not it's going to be repealed. And there is a very good chance that it could be repealed. Actually, in 2024, in early 2024, there was a bill that did pass the House, and it passed overwhelmingly. And in this bill, it not only repealed Section 174 for domestic R&D expenses, it left the capitalization there for foreign R&D expenses, but it also made it retroactive to January 1st, 2022. So, this bill is still out there. It wasn't, the Senate punted on it, and because it was close to the election, and maybe it's going to resurrect itself as part of tax reform in 2025. But this is something that, as a tech company, you need to stay focused on. Next slide, please. In addition to keeping track of proposed legislation related to 174, there are also long-awaited proposed regulations that are going to be forthcoming, hopefully in the next several months. Originally, we were expecting to see these proposed regulations in Q1 2025, but because of the 60-day hold on new regulations, my guess is that we're more likely to see something in Q2 2025. And why are these proposed regulations important? Well, currently we're relying on regulations that are pre-2022 and go back a long time ago. And we need to see these proposed regulations because the law changed so dramatically from an expense method to a capitalization method. And hopefully this will, the proposed regulations will be consistent with a lot of the guidance that the IRS has released to date. There's been a whole litany of IRS guidance in the form of notices and revenue procedures that have been issued over the last couple of years related to Section 174. My understanding is that the proposed regulations are going to be consistent with the guidance that's been issued to date, and will hopefully be even more robust in terms of the guidance. One important aspect of 174 is that from a SALT perspective, from a state and local tax perspective, there are some states that did decouple from Section 174 capitalization. So decoupling means basically they didn't adopt the federal change in law or the amended law. So states like California, for example, did not adopt the Section 174 capitalization, and taxpayers can still expense R&D costs currently in California. Next slide, please. Okay, I'm going to move on to the R&D tax credit. And for R&D tax credit purposes at the federal level, the form that you file is a Form 6765. And the 6765 historically has been a two-page form. There is a new revised draft form that's been released by the IRS that is going to be used for the 2024 tax year. And the new form is now 4 pages. So the IRS is requesting significantly more information than they've asked for in the past. And a lot of this is to help the IRS identify high-risk taxpayers, and so that they can spend their time better. But it's going to be a heavy lift for taxpayers that do claim the R&D credit. So they're phasing in the requirements of this Form 6760, the revised draft Form 6765. For 2024, all taxpayers are required to file the Form 6765 but you're not required to complete Section G of the form, which really is the heaviest lift that they're asking for. If you want to go to the next slide, please. And then in 2025, the Section G is required for certain taxpayers. The taxpayers that are excluded from having to complete Section G are taxpayers that have less than $1.5 million of qualified research expenses and have less than $50 million of gross receipts. So that's, you really have to focus on, you know, even if you have qualified research expenses that are less than $1.5 million, but you have greater than 50 million gross receipts, you would still be required to file this or complete the Section G. So just something to be mindful of. It doesn't take effect until the 2025 tax year, the Section G, but it's something you want to stay in front of. In terms of, from a state perspective, 38 states offer R&D tax credits. So like I said earlier, there's a lot of overlap here. From a state credit perspective, the focus is on the R&D the R&D expenses that are incurred in those states. And then, will some states require similar information as this new Form 6765? It wouldn't surprise me if some states followed this because the R&D credit is both contentious at the federal level as well as the state level. Next slide, please. Just a couple of slides just to show you the amount of additional information that the IRS is requesting. You can see this slide shows the 2024 information the IRS is requiring. And if you go to the next two slides, you can see there's about you can go to the next slide too, about 16 additional items that are required for the 2025 tax year in addition to those previous 8. If you want to go to the next slide, please. Just really quickly on if you do claim the R&D credit and you plan on filing a refund claim for the R&D credit, keep in mind that the IRS introduced some new procedures around refund claims related to R&D credits, and you need to provide a lot more information with the amended return than you had to prior to the date of January 10th, 2022. And this additional information includes items such as, a list of all the projects that you worked on, what you were out to discover, a brief description of the project. So if you do plan on filing any refund claims for the R&D credit, I would definitely advise you to speak with your tax advisor. Next slide, please. The last item I'll touch on is the payroll tax credit, especially for startup companies, small companies that are performing R&D tax R&D. If you're currently in a loss position and you can't use the R&D credits currently, there is an opportunity to elect to convert the R&D credits to payroll tax credits, and a taxpayer can do this for up to 5 tax years. And basically, the payroll tax, the R&D credits can be converted into payroll tax credits up to $500,000 in 2024, for example. And then those payroll tax credits go to offset your employer portion of your employee Social Security taxes. So that's 6.2% in payroll taxes. So a lost company can still generate a current cash tax benefit by electing the payroll tax credit. There are some requirements in terms of being a qualified small business, but again, feel free to reach out to us or your tax advisor. Next slide. I think that now we go back to Tom.
Thank you, Bob. We got some questions that came in. If you guys have any other questions, please make sure you throw them in the Q&A section below. I'm going to start with Bob, and then Jamie, I'll work back to you and Tom. A couple questions came in on our end. If my company is incurring R&D expenses and we have capitalized R&D expenses, haven't capitalized R&D expenses under section 174, and haven't claimed the R&D tax credit, what should we do?
Okay. Yeah, I run into this all the time, especially with, newer companies. So if you've been incurring R&D expenses and you haven't, capitalized the R&D costs, so under section 174, there are the IRS, at least through the 2024 tax year, allows taxpayers to file an automatic method change, which would allow you to basically true up for any costs that should have been capitalized, let's say in 2022, 2023. And the IRS allows you to make that true up, let's say in the 2024 tax year. And you can do it as what's called a 481A adjustment. And that 481A adjustment, although it's unfavorable, it's an add back to income in 2024, you're able to spread that add back over 4 years. Okay. So that's 174. From an R&D credit perspective, if you're capitalizing costs under section 174, then it's highly likely that you have some costs that are eligible for the R&D credit, and that would be a nice offset against the increase in taxable income from section 174.
Awesome, great. And just staying on that topic, what is the benefit at the end of the day of the R&D credit? Like, I mean, most of our tech companies that we work with, they're traditionally in a loss position, but as times have changed now with investors and how the outlook on getting to profitability, they're still in that loss position. So what is really the benefit there, even for a loss company at the end of the day, and just overall from that perspective?
Sure. Yeah, as an R&D credit person or specialist, I hate to see companies not take advantage of the R&D credit when they're eligible for it. But I understand that it does take time to calculate it. You do have to incur some costs. But if you're a loss company, there are benefits to claiming the R&D credit. So Tom, one of the benefits is the R&D credit has a 20-year carry forward. Okay, so even if you can't use the R&D credits today, it is an asset that can build up over time. And when you eventually do turn profitable, as long as it's within that 20-year period, you'd be able to use those credits. In addition, those credits can be a nice asset on your balance sheet that could be attractive to a buyer. So if you have an exit strategy where you're thinking of being acquired, that's definitely the R&D credit is definitely something that buyers are interested in when they look at targets, especially in the tech space.
Awesome, great. A couple of questions, Jamie and Tom, that came in, related to you guys.
Tom, before you continue, I just want to interject,
Yeah, sure.
add to Bob's, point on, the value of the R&D credit is at the state level, again, for companies that may be at a loss, a lot of states will allow the R&D credit to be transferred and sold. So there's a monetization that could happen from a state perspective to add additional value for those companies that may be at a loss position from a tax perspective. So just wanted to add that.
Hey, Jamie, I'm going to tag on to that. So another thing at the state level, even if you're in a loss position, you still may be subject to some sort of a franchise tax, right? Where you can use the credits to offset the franchise tax.
Correct.
Jamie, a couple questions came in relating to you guys. It says, my tech company likely has a compliance issue based on the presentation that we currently have, but we're looking at a potential sale soon. What steps can we take to remediate this matter? And does Citrin provide any services around this?
Yeah, so Tom, I'll let you actually grab this one.
Okay, yeah, so absolutely, that lends itself to the due diligence conversation that we had before. So what we would do is evaluate the extent of any liability, how far back it goes, what type of dollar amount we're talking. From there, once you know the level of exposure, the solution then can be found. And the most conservative way to go about it would be do a voluntary disclosure. a voluntary disclosure program is offered by most states out there. If we're going to generalize, limiting look back to 3 years, waiver of penalty. Any of the years prior to 3 would be expunged. In some very rare cases, interest is either limited or eliminated, but that's not very common. It's more the limited look back and the penalty abatement. And that's the most conservative, best way to handle it. If you're talking about a lesser exposure, we can prepare back returns, file prospectively, that type of thing. But you want to have those ducks in a row before the deal closes, because typically an escrow would be set up when an exposure is known going into the close of a deal.
And I'll add to what Tom said, in the importance of going through the process and dealing with these things. Again, we'll also deal with reducing escrows and all that stuff. And the voluntary disclosure importance, right? As Tom mentioned, the limited look back period. So, for those that don't file, right, that haven't filed yet, there's an unlimited look back period technically. There's what's called no statute of limitations. So technically the state could go after the company, we'll say conservatively going back to like 2018, when the Wayfair decision came, which allowed states to impose sales tax based on a company's economic connection to the state. So to underscore what Tom said, one of the values of that voluntary disclosure is limiting the years to look back, so that instead of going back to maybe 2018, it'll only be 3 years or 4 years. So it's a key part of some of the considerations when you're at a transaction point. And we always, and as Tom mentioned, we do the diligence reports. We also help companies. We regularly do voluntary disclosure applications and do all the filings for them, as well as help quantify when we're as part of the negotiation for various escrows, holdbacks, things like that.
Awesome, great. A couple of the questions that came in, they said that I've never even thought about sales tax since I don't sell physical products. But I have a concern, maybe we should be. What can we do to evaluate? What can you guys do to help us evaluate something like this? And what can we do internally?
Yeah, so I mean, I think the first step would be, having that first conversation of understanding the exact nature of the product and where the company may have a physical presence in terms of most likely payroll, as well as where the company is making predominant amount of its sales, with certain thresholds usually being 100,000, in some cases 500,000 certain states. And we can help, guide you in terms of where the issues are and how to file, right? We regularly, as Tom mentioned, take care of sales tax filings, and we work with third-party software providers that have an automated solution as well that we help from implementation, product setup, making sure it's connected to the customer's accounting system. So, we can do a full suite of services and comprehensive approach, or help the client and sort of as needed if they want to take it in-house and maybe handle their own compliance.
Awesome. One other question that came in, I think is meaningful. It's how can my company realize the savings upon, a sales and tax review at the end of the day? We talk about all this stuff in general, but what do we actually realize this at the end of the day as a company? Yeah,
so that got into when we talked about some of the reverse audit stuff, but we won't even call it that. We'll call it a sales and use tax review. In that, right, let's say, which we use real world example, we have a company that develops electronically delivered software or a SaaS product, right? And maybe the company makes a host of different purchases of other pieces of software and different taxable items and supplies. There's the potential for exemptions on that. And then there's things, right, where, like we talked about, vendors either may not necessarily know the law, there may be take a conservative view on certain exemptions. We talked about multiple points of view sourcing, that maybe software can be divided up to several jurisdictions. And so what we would do is just, again, taking a look at anyone that does a sales and use tax review, taking a look at the purchases, seeing the associated invoices and making sure One, that sales and use tax is being appropriately charged to correct anything so that going forward it can be done appropriately. And then seeing number two, going backwards, seeing, if there are savings in the way of refund claims. Every state allows, a business to file a sales and use tax refund claim with the look back period can be 3 years, some cases 4 years. And we can identify those purchases, file for refunds, and secure those dollar amounts as net tax savings to the companies for the sales and use tax they paid to vendors. Also going forward for companies that remit their own use tax, where maybe they're not charged sales tax, helping the company save going forward, right? Where maybe they're remitting taxes on a host of different products and services where they don't need to be. We can help them going forward so that, again, that's a tax savings just annually or, going forward as much as they purchase the item in question.
Great. I mean, all insightful things. And we thank you all for joining us today for our webinar on state and local tax strategies for tech companies in 2025 and beyond. We hope you found this discussion informative and helpful for you to navigate the ever-changing landscape of tax planning. Big thank you to our panelists, and we thank you for your valuable insights. We also appreciate your active participation throughout the session. If you have any additional questions or need further guidance, please don't hesitate to reach out to us. We are always here to support you with your strategic solutions for your business. Thank you again, and we look forward to connecting with you soon.